the financial centers of the world. This is Bloomberg Markets with Alix Steel and Guy Johnson.
Wednesday the 4th, 3 p.m. in London, 10 a.m. in New York, 30 minutes into the trading day in the United States. From London, I'm Guy Johnson, Alix Steel, of course, over in New York. Welcome, everybody, to Bloomberg Markets. Alix, 2 words. Yields down.
Yields down big. I'll make it 3 words for you. And that's exactly what we're seeing in the market. It really kicked up some steam to the downside with that Treasury refunding announcement. We'll get to that in just a moment. But yields now at 114, off the lows of the session for the 10-year, but nonetheless, the lowest we've seen since February. And the reaction is obvious in equities. It's going to be a little pressure on the equity market. Only utilities doing a little bit better within the S&P. Tech outperforming the best, but still in the red. The dollar also underperforming here. There was a little bit of more of a safety bid within the FX market, but that's cooled down a bit. And crude is getting knocked about, despite the fact you have a broadly weaker dollar. But yields low, yields low. The question is, how do you invest for that?
I wonder whether the data is about to change that. Certainly the ADP number was a little bit of a cold bucket of water for these markets, but the ISM services number is the exact opposite. The range 58 to 62, the headline number coming through at 64.1. Well above the highest aspects of the range that we surveyed. 60.5, the survey. In terms of the prices paid, this is where you really want to focus your attention. The prices paid index, Alix, is at the highest level since 2005 and has come through at 82.3. That is up from 79.5. There's a bunch of things we need to talk to Mike McKee about. We're also, remember, watching what Rich Clarida is going to have to say. Mike, first up, what do you make of these numbers?
Well, it does suggest that the service sector is rebounding much more quickly than the numbers we got from ADP told us this morning. ADP hiring disappointing in services, but here, as you mentioned, we've got 53.8 up from 49.3, a solid gain and definitely expanding. The other number that I was looking at, as you mentioned, prices 82.3. The production number and the business activities numbers also rise significantly, as do new orders. So it looks like services are doing just fine at this point. And the question is, why the disparity between the 2 numbers that we got today? I guess the tiebreaker will come on Friday.
All right, Mike, thanks a lot. I appreciate that. We're also looking at Vice Chair Rich Clarida. What do we know in terms of what he's talking about here with Adam Posen?
Clarida has 2 questions to answer for the markets, and he answers one and doesn't answer the other. The big question is, when do we start tapering? And we don't get a whole lot of him out of that. In his prepared remarks, Clarida says the economy has made progress towards its goal, the Fed's goals, which is the same thing they said in the statement. In coming meetings, the committee will again assess the economy's progress towards our goals. He does add to that, however, as always, there are risks to any outlook, and I believe the risks to my outlook for inflation are to the upside. So it is possible that he's giving us a hint they're getting a little bit nervous down at the Fed. The other question he has to answer is, when are they going to raise rates? And on that, he says, if the consensus for the forecast is right, I believe the necessary conditions for raising the target range for the federal funds rate will have been met by year-end 2022. So we would see rates rise in 2023. He says he's close to the Fed's consensus on GDP, unemployment, and core PCE. So at this point, he is looking for a rate rise in 2023, and maybe getting a little more nervous about inflation and the impact on tapering.
All right, Mike, thanks a lot. And Guy, you called it. You have that better services number, and you have those messages from Clarida, and you have yields now pairing some of those declines now pretty much flat on the day. The dollar also well off the lows of the session. All right, let's turn to the virus. The CDC and DC, I should say. The CDC is extending a ban on evictions in areas of the country with high transmission of the virus. That's the latest order to keep tenants who are at risk for losing their homes until October 3rd. Want to get right to our DC reporter, Anne-Marie Hordern. Anne-Marie, this came down yesterday. What do we know? How long does it last?
Yeah, huge turnaround, really, Alix, when you look at the fact that the Supreme Court basically said that Congress would have to legislate this, but now you have the CDC not really extending that moratorium. This is a brand new eviction moratorium. It'll go till October 3rd, so starting from yesterday, that's 60 days. 80% of counties, 90% of renters will be included, and the CDC says this is because it is really affecting counties that you have a spike in COVID cases. What is so interesting about this, and what many have said actually quite quite bizarre is the fact that the president alluded to the fact that it is likely going to face legal hurdles, but the administration seems to be taking this strategic look at this by, at least if we can get a little bit of an extension, even if there are legal hurdles, that will be enough time to try to get these local and state authorities to tap that billions of dollars, $47 billion worth of funds that were supposed to be there to help renters.
Anne-Marie, great stuff. Thank you very much indeed. Anne-Marie Hordern joining us from D.C. Let's turn to the virus in more detail. China is seeing its broadest COVID outbreak since the beginning of the pandemic. Authorities rushing to close tourist sites as the Delta variant spreads to nearly half of China's 32 provinces. It's doing so in just 2 weeks. Max Neeson, Bloomberg opinion columnist for healthcare, joining us now. The numbers in China are relatively low, but countries around the world are stepping up the action that is being taken. Israel asking people to go and work from home again, warning about lockdowns. A bunch of European countries are taking a very close look at what is happening here. Max, what do we know? What are we expecting in terms of what happens next?
Yeah, absolutely. So I think, of course, the key variant that's changed here is the variant. It's Delta. It's the fact that it's more transmissible. So all of these steps that China has been so aggressive about taking, that aggressive testing, contact tracing, targeted lockdowns, all things that just quite simply aren't going to work as well when you have a dramatically more transmissible variant. So places that are taking the tack of trying to keep their numbers incredibly low, looking at Israel too, it's just going to be more difficult in this environment. So if that's the attitude, if that's the stance, that's where you're going to see some more restrictions on travel, things like that may have a broader economic impact. The question is whether those deepen those restrictions or there's a move to sort of rely more on vaccination to prevent those severe outcomes and put a little bit less of an emphasis on spread and cases. That's difficult when you have the sort of economic effect that spreading cases have in the first place, which tends to dampen activity. So it's a really difficult task going forward when you think about what's changed with the Delta variant.
All right, Max, thanks a lot. I appreciate it. Max Neeson of Bloomberg opinion. Let's get back to the markets here. Treasury yields still falling, but pairing some of those lows, at one point hitting 112 basis points. The U.S. Treasury has set the stage for reduced government debt issuance in the coming months. Bloomberg cross-asset reporter Katie Greifeld is following that move. Hey, Katie.
Hey, Alex. Well, yeah, it's been an incredible bond rally. You have nominal 10-year yields hitting the lowest since February, a little bit higher now. And this really boils down to what's happening with real rates. When you strip out the effects of inflation, 10-year real rates hit negative 121 basis points today. That is another record low. And as you can see in the chart, it has just been a steady grind lower. And what's interesting is that we know the demand for bond is theirs, but the supply of treasuries is set to come down as well. We heard from the Treasury Department in a statement today saying that it expects to announce auction size reductions as soon as November. So no changes to auction sizes this quarter, but the supply cuts are coming. So we'll find out soon enough whether that will add further fuel to the bond rally we're seeing.
Thanks, Katie. Great update. Katie Greifeld joining us on what is happening in the fixed income world. Let's talk about equity world. Abigail Doolittle is here to talk about what we're seeing in the earnings story.
Well, Guy, it's a mixed picture at this point. We have two leaders and two laggards. To the upside, we have Activision Blizzard popping higher after they beat estimates, revenues by 20%. The outlook is also strong. Live Nation up nearly 4%, narrower loss than expected. Encouragingly, the CEO is saying that they expect concerts to really rebound. Interesting given the Delta variation really on the rise. To the downside, though, GM down 7.4%, and they missed adjusted earnings by 8%, having to do with the supply chain and the chip shortage. However, that stock's also up more than 120% over the last year. So really priced to perfection, not delivering it. And then finally, Alex, CVS down 2.2%. That company, the management, citing rising inflation as something that is weighing on the stock today for sure.
Yeah, and wages.
Wages as well. They're
yeah.
raising wages to $15 per hour, but the debate is that actually enough?
Right. Fair point. Abigail, thanks very much. Bloomberg's Abigail Doolittle joining us. All right, coming up, more on all those market moves. Are investors gearing up for a stock rout? Well, Jordan Jackson, JP Morgan Asset Management Global Market Strategist, will join us next. What do you do? Yields at 113 basis points. This is Bloomberg.
U.S. is a heavy growth market. And if you believe bond yields are going to edge higher, then growth stocks are going to take a little bit on the chin. And that's why you'd probably want to be in more value-oriented areas.
That was Tobias Lefkovich, Citi's chief U.S. equity strategist, speaking earlier on Bloomberg on the bank's recent downgrade of U.S. stocks that are vulnerable to rate rises. Joining us now, Jordan Jackson, J.P. Morgan Asset Management Global Market Strategist. Jordan, part of that call is, 2%, 1.7% on the 10-year. It feels really hard to get to that level right now when you're seeing such a decline in yields. But how do you square low yields and what you do in the equity market?
Well, as highlighted, I think it certainly spells a bit of concern or trouble for the growthier parts of the market, right? And I think that's where the vulnerability lies at 115, between 120 on yields. Any sort of backup 20, 30 basis points could certainly spell danger for the growthier parts of the market. And I think it also plays into sort of the value-orientated parts of the market in favor of value, but not just all types of value, because we know all value is not created equal. And I think the move that we've seen in markets so far year to date is a reflection of that, right? Energy and financials are the top two of the top two of three performing sectors so far year to date, whereas consumer staples and utilities are sort of laggards. And so, I think you want to be positioned sort of in the cyclical value parts of the market. But again, I think, it's a difficult call to make, and where yields are at is certainly puzzling, I think, a lot of economists as well as investors as well.
Yeah. Jordan, yields have been tracking lower for a while now. This isn't a new phenomenon. They've been going lower and lower and lower. We had a kind of a really big move down earlier on in the session. We're getting near some big technical levels. 1% isn't that far away. How convinced are you that we're near the trough when it comes to the 10-year?
Well, I do think that we are in a position where over the next couple of weeks here, potentially till the end of September, that yields are going to stay pretty low. And I think it's partly reflective of the supply and demand dynamic that we're seeing in the market. Obviously, we know stimulus has come by the way of the drawdown on the Treasury general account. So the Treasury isn't issuing as much debt, and they're already talking about reducing auction sizes. In a world where you're flush with liquidity, on the demand side, you're still seeing very, very strong demand for bonds. And so I think that dynamic could continue to play out again through August and into September until we get some sort of resolution on the debt ceiling.
So Rich Clarida was talking earlier to Adam Posen, some of the headlines that came out. Risks to his inflation outlook to the upside, but still sees the conditions for rising rates could be met by the end of 2020. Do you think the market's prepped for an end of 2020? Sorry, end of 2022. My bad. End of 2022.
I think so. When I think towards the end of 2021, again, I think yields sort of are released from this technical hold sort of towards the end of the third quarter and allow them to realign themselves with the fundamental picture as we move through the fourth quarter and into the first half of next year. Remember, this is also going to be at a time where the Fed is going to be stepping off the gas in terms of its asset purchases. And so you have an environment where hopefully, that the demand side obviously is going to remain robust. You'll start to get some supply coming back in, but then the Fed sort of hand of demand is going to start to pull back as well. And I think that's when yields can start to align with fundamentals and start to move higher. It's just that yields at 112, they're currently signaling a permanently impaired economic trajectory over the course of 2022 and 2023. And that's just not what we're seeing from a fundamental perspective. If we look at things like copper gold ratios, equity market valuations, commodity positioning, all these other more growthier signals are suggesting that bond yields should be much higher than where they are today.
Jordan, let's take another tack on this. Stay-at-home stocks have had a tough time recently. And I'm wondering whether, with the Delta variant spreading in the way that it is at the moment, whether that trade is worth another look.
I think it's going to be a start and stop. It's going to be a bumpy road. We don't necessarily know. No one necessarily knows how things are going to play out here. I think you need a balance between both. I think you need a balance between the reopening trade, the reflation trade, which is certainly plays well into the cyclical value parts. But I think you also need to complement that with the still structural defensive growth story. Again, this is going to be a start and stop reopening type of process. And so we haven't signaled the all clear. And I think with this environment, investors will need to sort of rent cyclical value and own structural growth in this environment.
Does that view also apply regionally? Is that still is there room to buy Europe as the value and then also buy the U.S. as growth?
I think so, but I think, getting in now could feel a little bit early. There's still a lot of starts and stops when we look at the Eurozone. I think the UK is sort of a bright spot in terms of its vaccination pace, which has been very strong. But I think broadly within the Eurozone, again, there's still some starts and stops, some concerns there. I think specifically within Japan, obviously, are dealing with another wave. And so it could feel a little bit early getting into sort of your developed market names today. We could still see a little bit of U.S. exceptionalism over the next couple of weeks here. But again, I think as we move through the fourth quarter, as that global sort of cyclical trade comes back into play, I think that's where you do want to start to be looking for opportunities. And then I think in the first half of next year, that's really where EM starts to become a bit more interesting. Again, as they get over their COVID curves, obviously, more recently they're dealing with higher levels of inflation, and so central banks have to be a little bit more aggressive. But I think, as we move through the first parts of 2022, that to change. And so a little bit more as we move through the back half of this year into next year, a good mix of U.S. and gradually moving into the international space, I think makes a whole lot of sense.
What do I buy to introduce portfolio protection? On both sides, I'm curious. A lot of people have been piling into tips, trying to kind of hedge the inflation risk on the upside. But that trade looks like it's going to be a really tough one, given where we are with valuations. Where else can I build inflation protection into my portfolio? But where on the other side can I also build downside protection in as well? How do I construct a portfolio, given where equity valuations are right now, that gives me kind of some optionality when it comes to inflation, but also some downside sort of protection if the market decides to turn?
It's a great question. I still think you need a little bit of duration in that type of environment for protection, right? I still think, bonds are still sort of the hedge to the equity markets. I do think that you probably still need some more hedge type of equity products, sort of put strategies if you have to provide some downside protection. And I think more broadly, when we look towards, just the bond market and protection and hedging against inflation, investors really have to ask themselves, do I want to hedge against inflation or do I want to outperform inflation? Now, look, I think, tips are generally up about, less than about 4 to 5% so far in the year, but equity markets are up in double digits. And so when you're constructing a portfolio, you really have to be cognizant of again, you constructing a portfolio that's going to outperform in inflationary environments, because I don't think just hedging is going to get you where you need to be. And so it's a collection of equity exposure. Obviously, I still think the value trade, as I mentioned, has some rooms to run. And then I think some of the more commodity sensitive parts of the market, when you look at industrials, materials, are a way that you can play that as well.
Jordan, we're going to leave it there. Always great to catch you up. Thanks for your time today. We greatly appreciate it. Jordan Jackson of JP Morgan Asset Management, thank you very much. Some more headlines coming through from Adam Poden's conversation with Rich Clarida. Clarida talking about the fact that he's been a little surprised by the size of the bond yield decline that we've been seeing recently. That conversation ongoing. We're going to catch up with Adam a little bit later. There's going to be a global move down in real yields. Yield moves probably partly reflect, he says, virus concerns, Alex.
Yeah.
So it's interesting that he's highlighting that kind of virus fear, and you can see that. You look at other areas in the equity market as well. You look at what's happening in the transports, for instance. That fear definitely represented there.
Yeah, and also that echoes what a lot of strategists say. Like 112 basis points in the 10-year does not make sense for what we're actually seeing. So reflecting that virus fear, which we don't know how that's going to play out. The stay-at-home recovery. That's what I've been saying.
Been saying it for a while.
Anyway,
we're going to talk about Robinhood. It's surging. Maybe it's part of that narrative as well, that stay-at-home story, rising to a record, $85 in early trading. The jump triggering at least 2 trading halts. We'll see what happens next. We'll be covering this story on this program. This is Bloomberg.
It's time for the Bloomberg Business Flash. A look at some of the biggest business stories in the news right now. I'm Ritika Gupta. Bloomberg's learned that SoftBank Group has quietly built a $5 billion stake in Roche. The Japanese firm is betting on the drug maker's strategy of using data to develop drugs. Roche's Genentech division focuses on that, and SoftBank believes the business is highly undervalued. It was a rare quarterly earnings miss for General Motors. The automaker was hurt by the $800 million cost of the recall for the Chevy Bolt battery fires. And CEO Mary Barra tells Bloomberg that the company is still dealing with the semiconductor shortage.
We'll be very fluid. Right now, we work, and it's on a daily for the team that's working on it, but weekly from a leadership team. We're looking at making sure we understand the semiconductor situation, and we're allocating chips to our highest demand to take care of our customers, and also the vehicles that are in plants that are capacity constrained, and that is especially our full-size trucks and SUVs. So you'll see us continue to do that.
Meanwhile, GM has raised its guidance for the full year. And that is your latest business flash. Guy, Alex.
Rika, thank you very much indeed. So after last week's disappointing trading debut, Robinhood shares now rallying and rallying hard. It's now trading well above its IPO price. That was 38. Bloomberg senior stocks editor Dave Wilson is looking at what is really quite the comeback for the Hood.
Oh, no question, Guy. I mean, this is a stock that fell 8.4% on its first day of trading after having been priced at the bottom of a projected range. It got stuck there the next couple of days. Yesterday, up 24%. Today, it's been up as much as 82%. And it's hung on to most of that gain, at least for the moment. And then you look at how much trading is happening in this stock. Typically you get a first day surge and then things kind of settle down. Well, yesterday you came close to having as many shares traded as you did last Thursday in that debut. And today you've already seen more than 60 million shares change hands. And we have a projection that you may be somewhere around 217 million by the end of the day, which comes close to having each share of Robinhood that was sold in the initial public offering changing hands 4 times. So that gives you some sense of how much volume there is and how much volatility there is in this stock.
Yep, Dave, thanks a lot. Really appreciate it. Bloomberg's Dave Wilson joining us there. Guy, you just like saying hood. You think that's pretty funny, right?
It just makes me chuckle.
It does. I could tell when you say it. But it was quite a move. I mean, you missed it last week, but that IPO, well, you just saw it. I mean, you saw the bid ask just start to fall, and when it opened, just crashing like a stone.
Alex, just reminding everybody that I've had a nice 2-week holiday. It is fading into the rearview mirror very, very quickly. Alex, we need to talk about your favorite subject.
Yeah,
oil.
Oil's coming up. So Big Oil's trying to return money to shareholders. Scott Sheffield of Pioneer joins us next. This is Bloomberg.
Half past the hour, live from London. I'm Guy Johnson, Alix Steel over in New York. This is Bloomberg Markets. I bring up the fact that it is half past the hour. We're waiting for the data to come through on the inventories. Is this the data last time round that was incredibly late?
Yes, but that was like 3 weeks ago, Guy, because you've been on vacation for 2 weeks.
Again, with the reminders. But my point is that I hope it shows up on time.
Yes, me too. But so something that we've seen, oh, it is out. Look at that. Okay, so let's get right to it. We have overall inventories actually built by about 3.6 million. That was unexpected. We were expecting actually a decline, but Cushing declined pretty nicely. And gasoline inventories drew a bit. And you are seeing a little lower refinery utilization. So they're using a little less oil, so you get that build, but then they're also definitely making products. Inventories are drawing there. You also have to wonder what's actually being imported right now and what's kind of maybe stuck on the U.S. Gulf Coast in terms of transportation, so that inventory build may be a touch distorted there. We'll get some details in just a sec. So let's dig deeper into oil as well as what it means if you're running a business. Scott Sheffield, Pioneer Natural Resources CEO, joins us now in studio. Thank you very much. Good to see you, Scott. Thanks for joining us.
Alex, it's been a long 18 months, so it's great to be here.
I know. Absolutely. Well said. Okay, so what's the state of the oil market from your point of view?
I think it's probably better than I've seen it in time in the last 10 years. I think OPEC and Russia have really put together a great agreement. It's working. It's all about inventory reductions. around the world. Demand's coming back. The vaccine's working. It's a slower pace. Everybody's dealing with the Delta variant, but it's going to roll over, in my opinion. Demand's going to come back stronger the last half of this year and going into 2022.
So in preparing for my interview with you, the questions I kept getting were around hedging. Like for some reason, investors just do not want oil companies to hedge right now. The idea, though, is that you're going to hedge, you're going to lock in an oil price, it secures the kind of money that you're going to get in the future, and that's kind of why people hedge. A lot of analysts say, no, don't do that anymore, Scott. And I talked to Paul Sankey of Sankey Research last week, and this is his question to you. Let's listen here.
But I really don't want any hedging at all from these guys if they really believe in their business model. He's got a variable dividend policy. Why is he hedging away my variable dividend? But I really don't think they should be hedging any of them if they've got a good business model.
What are your thoughts?
Yes, what's changed is that we used to spend every dollar to drill a well, 100% of our cash flow. Today, we're only spending 50%. And so we're going to be distributing over $23 billion of free cash flow back out, and $18 billion of that's going back to the investors. In talking with them, they do not want us to hedge. I think more people think there's more stability in the oil markets today, and the feedback that we're getting is no more hedging. The only hedging we may do is protect the capital budget, but it'd be less than 50%. It may be 20% or 25%. But really, for that variable dividend, which we're paying out a significant amount to shareholders, most of them at this point in time do not want us to hedge.
Scott, great to see you in New York. It's Guy in London. Let's talk about dividends versus buybacks. Oil stocks are trading at a discount right now. Why go down the dividend route and not the buyback route?
In fact, we started the variable dividend about 18 months ago, Guy, and that's through feedback through all of our shareholder base. So we started talking about about 18 months ago, and 99% of them did not want buybacks. They wanted to get the cash, and if they decide to buy Pioneer stock or Exxon stock, they would do it themselves. They want the dividends first. Now, during dislocations, Pioneer is going to have a great balance sheet, and we could easily go into the market and buy back our stock. So if we see a dislocation like we did last year, we could easily do that. Hopefully that dislocation won't happen again. Like I said, I'm more optimistic about stability, less volatility in the oil markets over the next 5 years.
In a just-in-case kind of way, I hear you that investors don't want you to hedge, but would you consider hedging differently, like buying puts instead? So you're not capping upside, but you're protecting downside. Like, is that something that investors and shareholders want right now from you, too?
If we saw, I don't think we're going to see this, but if we see a run to $100 for some reason, the problem is it's in backwardation. But if the strip is 5 years, $100, then yeah, you could easily buy a $70 put. That's fairly cheap. But if you buy an $80 put or $90 put, it's too expensive.
I see.
So there's always that one scenario that you could evaluate it.
Scott, can I ask a few sort of operational questions? Are you struggling to get your people vaccinated? How many of them are vaccinated? What kind of price inflation are you seeing in terms of labor and in kit? I'm just kind of wondering what's going on the ground right now.
Yes, our headquarters is in Irving, outside of Dallas. We're 80% vaccinated in our what we call our Las Colinas office. Out in Midland office, we're 60%, and we're about 35% out in the field. The field's working 24/7, so we're trying to get our field. We're not mandatory yet, but we're close to it. We're trying to get our field to really go out and get the vaccine. It's available everywhere, and as we all know, the Delta variant is much more contagious and spreading. We've seen about a 10% increase from the beginning of the year to the end of the year on cost of inflation. We're building that into our 2022 capital budget.
Is that labor? Is it input costs? Is it chemicals?
No, it's more steel and cement. So steel costs have skyrocketed, especially with this infrastructure bill if it gets passed. I think steel will continue to increase in price. So it's primarily steel. Diesel a little bit with the price of, we're trying to move off diesel for ESG reasons, obviously, but it's more steel and cement.
Interesting.
Are you struggling to hire?
No, not at all. In fact, one of the interesting things is our attrition rate at Pioneer for technical people used to be in the 6 to 8% range. It's down to less than 1%. The primary reason is the private equity firms, they're no longer rating Pioneer or other companies. And so that's a big benefit as to the slowdown and what's changed with private equity. So our attrition rate is the lowest I've seen in probably in 20 years.
Let's go to the M&A landscape. On the call yesterday, you were really adamant that you were not going to be making a bid for Shell's Permian assets. This is a really unfair question. Who do you think will buy it and should buy it, and will the market like it?
Yeah, that's a good question. I saw there was a small deal announced by a company called Callan. They bought a company today. Their stock's down significantly. So the markets go, I think the market, what's interesting, the buy side wants consolidation, but they don't want you to do it. And so is what I'm seeing. And so whoever buys Shell, they're probably going to have their stock, depending on the price, whoever buys Shell, it depends on what's going to happen to their stock price. I would anticipate their stock's going to fall. But that's just the marketplace. Now, Pioneer has over 15,000 drilling locations. So that's the reason I stated yesterday, we don't need any more. It'll last us for 20 years, all tier 1 locations. So there's no more reason for Pioneer to do any more M&A. So I think the market has it. It's probably the bigger companies. I don't know if it's Chevron or ConocoPhillips, but it's somebody that has to be fairly large to buy Shell's Permian assets.
Scott, one final quick question from me. The regulatory environment is tough. You know this more than anybody else. Do you think it gets tougher from here? I think there was a piece in the Times this morning. I think it was Senator Van Hollen looking at polluter pays legislation, basically asking big energy to step in and fund the bill for all the wildfires and the flooding and the freezing conditions that you know so much about, basically to foot the bill for that. Do you think the regulatory environment gets tougher? Do you think the cost of being an energy company is going to get higher?
Yes, Guy. I did read the article. I've been stating that so far the Biden administration's policies are all based on importing more oil from the Middle East, less from the U.S., as we have reached pretty much North American energy security. In regard to what was proposed by Senators Sanders, I just don't see it's going to happen, to tax Scope 3 from each oil and gas company for the next several years. There's enough senators and enough people in the House, I think, that will stop anything that is that critical to the oil and gas industry. So our industry has probably done the best. People don't recognize it in regard to reducing CO2 emissions and greenhouse gas emissions with what happened to the rise of the gas shale industry. So the reduction of coal has really showed what this industry can do in regard to reducing CO2 emissions going forward.
Scott, last question from me also. Let's just put us all in a nice, pretty bow. What the industry has become much better at is producing more for less and spending less. And I wonder, when you talk about the increases in costs, like with steel and cement, and the possible any regulatory overhang from D.C., what point do you have to start spending more to keep production flat, never mind growing it?
Yes. Excellent question, Alex. We are still seeing tremendous capital efficiency. We're drilling 15,000-foot laterals. We're fracking 2 wells at the same time. We call it simul-frac. And so we're seeing a lot of capital efficiency. So over time, we'll think we'll need less capital to drill the same amount of wells. So that offsets any inflation. So we're still depending on that. So I think that's a big positive that will continue. And that's why we're very strong about saying only about 50% of our cash flow will be spent to grow about 5% a year.
Scott, it's always a pleasure. It's great to see you in person. I love your candor. Scott Sheffield, Pioneer Natural Resources CEO, thank you very much. Guy?
Yep, people need to get back on planes. They need to travel. We need to start moving around a little bit. Great to see Scott in the studio. I want to talk a little bit about some breaking news. A couple of pieces of breaking news that we've had over the last few minutes. Boeing stock rising reasonably sharply at the moment. A 737 MAX, we understand, is departing for China. This is a hugely significant moment for the MAX, for Boeing. There has been this concern amongst analysts that Boeing has a China problem. Airbus has been making hay while the MAX has been having problems. We still don't have certification from the Chinese. The FAA, EASA in Europe have certified the aircraft, recertified the aircraft. The Chinese, the real kind of missing piece of the puzzle. It's going to be interesting to see exactly what happens here, how long this takes, but an aircraft is on the way, hopefully, to get certified. That's where you're getting the stock market reaction that you are seeing. And Alex, we are getting news out of the UK as well.
Yeah, UK.
UK is going to offer coronavirus vaccines to 16 and 17-year-olds.
Yeah, to age 16 and over. The U.S. is definitely moving that age limit down. I wonder, though, for the U.K., kind of where it sits. You were skeptical that they were actually going to move vaccinations down to like 12 to 16.
Yeah, I think this looks like an incremental approach. The risk gets greater the further down you go. The opportunity obviously becomes lower because the kids are recovering very quickly from Delta virus, from the Delta variant, and as a result of which the risk reward kind of changes as you go down the age cohort. But it's interesting that they're kind of doing incrementally step by step. We'll talk more about what is happening with the impact of Delta on the global economy. Coming up, second quarter profits for PE firm Apollo, beating estimates, driven by its buyout business. We're going to speak to Apollo's co-head of private equity about where they're investing and where they're going to put money next. A lot of dry powder out there. Where's it going? This is Bloomberg.
This is Bloomberg Markets. I'm Ritika Gupta, and you're looking at a live shot of the principal room. Coming up next, we have the Honeywell Chairman, President, and CEO. Catch that at 11 a.m. in New York, 4 p.m. in London. This is Bloomberg.
So Apollo's second quarter profits beating estimates. The results mark something of a turnaround for the firm from this time in 2020 when its holdings in, well, energy, travel, retail, understandably taking something of a hit. Here with us now, Apollo's co-head of private equity, David Samper, in an exclusive interview. We're also joined, of course, by Bloomberg's Sonali Basak with us in the studio. David, great to have you on the program. Thanks for your time today. We greatly appreciate it. I'm curious as to how you see conditions evolving at the moment. You've taken the opportunity with these solid markets to exit a number of businesses. That's really driving results at the moment. Where are we now? What's the strategy going forward?
Yeah, well, first of all, thanks for having me on this morning. You know, our private equity business is really firing on all cylinders. If you look at the three components of what we're focusing on, deployment, realizations, and value creation, all three are doing well. You know, what you were saying on the deployment side, we've invested $10 billion, over $10 billion through the first 8 months of this year, which is a record-setting pace for us. Our funds are performing well. You mentioned in the lead-in, we're up in the quarter about 10%. Our ninth fund, which is our most recent fund, is up 49%. It's got a 49% gross IRR, 28% net IRR. And from a realization perspective, we realized $7 billion of capital in the quarter. So really firing on all cylinders. And we're seeing opportunities in some of the sectors that were the most hard hit from COVID, like you mentioned.
Well,
travel, tourism, leisure, and entertainment.
Some of those sectors, you really have been leaning really hard into them. Some of the first deals that we saw coming out of some of this crisis were made by you. But I'm wondering how you're thinking about those industries as the Delta variant spreads, David.
Yeah, it's a huge point. I actually have a board meeting today for a company that's in the travel and tourism space, and Delta's been a big discussion. You know, big discussion for those companies, big discussion for companies like Apollo as we think about returning to the office in the fall. I think currently, in the real-time data that I've seen in our portfolio, it actually hasn't manifested itself in that much of an impact, which is pretty amazing. Even in hard-hit states like Texas, Florida, and Nevada, tourism seems to be hanging in there. But undoubtedly, it's something that needs to be focused on. And I do think when it comes to return to work in cities like New York and San Francisco, I do think you're going to see more caution as we head into the fall.
We're going to want to talk more about investments. But before we get there, since you raised return to office, Apollo has been looking at West Palm. They have been looking at outside of New York for offices. How are you thinking about your footprint as people return to the office and want to work from different places?
Yeah, so it's the new Apollo. You know, I think flexibility is the name of the game. When it comes for us in our business, I think that we've really preached the mantra of flexibility. I think we've proven throughout COVID that we could be highly effective. In fact, if you look at the bottom line, I think more effective than we've ever been in our history through a flexible work environment. So as we head back for the fall, we've really preached to all of our businesses to lean in and embrace this flexibility and go where the market goes. You know, we're in a competitive industry. Our portfolio companies are in a very competitive labor environment. And I think businesses that just want to go back to the way things were are missing a huge opportunity to learn from what's gone on over the last 18 months.
Well, speaking of flexibility, there's this time right now where banks are trying to hire, private equity firms are taking some talent away from them. Deal flow is still so aggressive. So what kind of flexibility can you offer to young people by means of time off, more pay? What are they asking for?
I think it's all those things. It's been pretty eye-opening to me to see how quick the market's moved. But again, I think we need to lean into it and embrace the change. When it comes to work-life balance and flexibility, I think flexibility is the key thing. So allowing people to work remotely, allowing people to work out of the office several days a week has been something that we've been really focused on. Allowing people to have protected time off, which is something that I think was a very foreign concept in the financial industry, as little as 5 years ago, is something that, we focus on a lot. There's been a lot of studies done about how you really lower your productivity if you don't take time to recharge. And I think that's something that, we've looked at the data and we've shared it with our employees. And it's not just talk, but it's actually action. And people have to model these behaviors too. So I think a lot of this is not just going on at Apollo. I think you're seeing it in banking as well. And I think it's a good thing.
David, hi, it's Alix next to Shonali here in New York. Quick question on vaccinations. Are you requiring workers to get vaccinated or show proof of vaccination, et cetera? How are you dealing with that right now in the middle of the Delta variant?
So at the portfolio company level, we leave it up to the portfolio companies. And I'd say most have not, but I do think the landscape is changing. At the Apollo level, I do think that we announced, I think it was reported, that we are asking people to get vaccinated before returning to the office.
David, I'm really curious about some of these new age investments you're making over at Apollo, an investment in a fintech investor, a partnership with a blockchain company. What does this say about your evolution as an asset manager and your transition to the future?
Yeah, so a lot of these investments that are up on the screen right now are investments that were made at Apollo. I do think that Apollo, as a public company, is embracing change, like I said, and really leaning into technology. If we're going to be the leading alternative asset manager in the 21st century, we have to embrace technology, the good and the bad of it, and really think about staying ahead of the disruption curve. And I think a lot of these investments, particularly Motive and Figure and 25 Madison, allow us to look across our portfolio of businesses throughout Apollo and become a cutting-edge asset manager.
David, you're pretty good at pricing companies. What do you make of the prices of some of these fintech businesses?
I think valuations in general, it's hard to not look at valuations in general and say they're high. We're living in a world where money has no cost. In fact, in some cases, has a negative cost. And I think that's being manifested in valuations, particularly for long duration assets, of which fintech, I think, would qualify. And I think our challenge when it comes to allocating capital to holding company or allocating capital for our funds is trying to make sure that through adding value, through ingenuity, hard work, managing through complexity, we could add value to buy down these otherwise, I think, quite expensive valuations.
David, thank you very much for joining us. We appreciate it. David Sambor, Apollo Global Management, co-head of private equity, and Shonali, thank you very much from Shonali Basak joining us as well. This is Bloomberg.
The biggest places where we're seeing cost increases on wages, actually. We're having a hard time getting people, especially at the entry level, hourly labor. We're having to increase our wages, and we're still not up to full employment in the company.
That was Bob Patel. He's LyondellBasell, a CEO. He spoke to me earlier for Commodities Edge Guy, and LyondellBasell makes plastic stuff. So they make like all the stuff that everybody is buying, basically. And I said, I asked him after, I said, well, is this temporary? Like, do you feel like you're going to get workers faster? He's like, I really don't know. He's like, this could be a permanent shift in the industry.
There's huge amounts of uncertainty, isn't there? And I think this is something that's manifesting itself in so many areas. We were hearing from Pioneer a little bit earlier on. Rich Clarida, in some ways, causing kind of as somebody said on the Markets Live blog on the Bloomberg terminal, we're at peak uncertainty right now. So many kind of issues surrounding this economy we don't know yet. When do we start to get clarity, I think, is a key question that investors still don't have the answer to. It was interesting. What is it? CVS today upping it to 15?
But that's that's like 2022, so they're definitely pushing it up. What I also find interesting in talking to Mr. Patel is that in terms of the demand side, he does not see this being a cyclical kind of thing. He's like, demand is huge, supply is not there. This is not a short-term fix. Obviously talking his book, but the idea that this won't be an up and down thing, that this may not be a transitory situation.
Yeah. Well, again, we come back to the Fed. What is the Fed gonna do with this? Rich Clarida talking about the conditions for a rate hike maybe being available by the end of this year. Steen Jacobson, Saxo Bank's CIO, is going to join us. We'll definitely talk to him about this. That's next. This is Bloomberg.